If you're like most Canadians, you probably have a TFSA. Maybe your bank helped you open one, maybe you're even contributing to it regularly. But here's the real question. Are you actually using it in the right way? Because the truth is, most people aren't. In fact, one of the biggest financial planning mistakes I see, even among high-income professionals and business owners, is treating the TFSA like a basic savings account. They leave it sitting in cash instruments, earning next to nothing, while missing out on one of the most powerful tax-advantaged investment tools available in Canada. Let me give you an example. Imagine two people each contribute $8,000 a year for 25 years. One keeps it in a high interest rate savings account, earning 2%. The other invests it in a well thought out portfolio, earning a 6% average return. By the end of those 25 years, the difference isn't a few $100s. It's over $200,000 in tax-free gains. And here's the kicker. The second person can withdraw all that money at any time with zero tax impact. No capital gains tax, no income tax, no OAS clawback, just pure, flexible, tax-free income. So if you're only using your TFSA for parking cash, or if you're not contributing at all because you don't have a goal for it, you're leaving serious money on the table. Today, I'm going to show you what most Canadians get wrong about the TFSA and how you can use it the right way to grow your wealth and reduce your lifetime tax bill. Hi, if you're new here, my name is Stefano Francescut and I'm a certified financial planner professional at Next Step Wealth Management with IPC Securities Corporation. For over 30 years, I've been helping Canadian families, professionals, and business owners make smarter financial decisions with a focus on tax efficiency, retirement readiness, and long-term planning strategies that the average bank or advisor simply doesn't talk about. And today, we're digging into one of the most misunderstood accounts in Canada, the tax-free savings account. Because while almost every Canadian has one, very few are actually using it to its full potential. Let's break it down. Part one, why the TFSA isn't just a savings account and never was. Let's clear something up right away. Despite the name, tax-free savings account, the tax-free was never meant to be just a place to stash your emergency fund or let your money sit in cash earning 2%. I have a better name for it I'll share with you shortly. The TFSA is actually a tax shelter, a powerful investment account where your money can grow completely tax-free and be withdrawn without triggering income tax, capital gains, or even government benefit clawbacks. That makes it one of the most flexible and efficient tools available in Canadian financial planning. But the name, unfortunately, it's one of the biggest sources of confusion. When most people hear savings account, they think of a traditional high interest rate savings account that they open at the bank. So what do? They open a TFSA and leave it in cash, GICs, or other basic money market instruments, often for years. And the opportunity cost of doing that, it could be significant over time. Here's that example. Investor A contributes $8,000 per year into a TFSA and keeps it in a 2% high interest rate savings account. Investor B contributes the same amount, but into an investment portfolio with an average annual return of 6%. Over 25 years, both investors contribute a total of $200,000. Investors A TFSA, growing at 2%, will be worth approximately $261,000. Investor B's TFSA, compounding at 6%, could grow to over $465,000. That's a difference of over $200,000 just by using the TFSA as it was intended, a long-term tax-free investment vehicle. Now, to be clear, investment returns are never guaranteed. They depend on market performance, asset mix, and your personal risk tolerance. But this example illustrates a common scenario, one I've seen many times in practice. Look, if your goals and objectives dictate sheltering income, otherwise it would be taxable within your TFSA, then that's a pretty good choice, as long as it was a purposeful decision. When used properly, the TFSA can become one of the most valuable accounts in your long-term retirement strategy, not just a place to park cash. So if you've been treating your TFSA like a savings account, now might be the time to reframe and rename it as what it truly is, a tax-free investment engine that grows with you. Part two, why the TFSA is one of the most powerful tax tools in Canada. Unlike RRSP accounts, which are tax deferred, the TFSA gives you something even more powerful in retirement, tax-free income. Here's why that matters. Withdrawals don't count as taxable income. They don't affect government benefits like old age security. You don't pay capital gains tax on any investment growth, and you can recontribute amounts that you've withdrawn in future years. That last point is key. If you withdraw $10,000 this year, that $10,000 gets added back to your contribution room on January 1st of the next year. Used correctly, your TFSA can be a tax-free income engine in retirement, allowing you to draw income without triggering higher tax brackets or benefit clawbacks. Also, because it's tax-free money, you need less to accomplish the same income goal. At 36% tax bracket, you would need to take $31,250 from your RIF in order to spend the same $20,000 from your TFSA. It's one of the few accounts where the growth, withdrawals, and income strategy can be aligned for maximum efficiency if you plan ahead. Part three, the real cost of playing it too safe. Here's where the TFSA mistake really shows up. When people treat it like a short-term savings vehicle instead of the long-term tool it can be. Let's go back to investor A versus investor B. The $200,000 difference in outcomes, that's just not about missing out. That's potentially $200,000 of tax-free income that could have supported your retirement, help fund your children's education, or even been passed tax-free to your estate. And remember, this isn't about picking risky investments. This is about understanding how time, compounding, and tax-free growth work together, and making sure your TFSA is being used to match your goals, not just parked in cash out of habit. If you're still decades from retirement, your TFSA could become a powerful supplement to your RSP, offering tax diversification that gives you more flexibility later on. If you're already in retirement, it can help provide tax-free withdrawals to help manage your taxable income and help you avoid crossing into higher tax brackets unnecessarily. Either way, using the TFSA correctly starts with a clear plan, not just a high interest rate savings rate. Part 4, a few TFSA reminders most Canadians overlook. Let's wrap up with a few key reminders. Your TFSA contribution limit in 2025 is $7,000, and the total cumulative room since 2009 is now $102,000 if you were 18 or older in 2009 and a Canadian resident every year. You can hold investments inside your TFSA, ETFs, mutual funds, stocks, bonds, GICs, not just cash. If you over-contribute, you'll be penalized with a 1% per tax month on the excess. So it's important to keep track of your room carefully. And remember, withdrawals don't affect your eligibility for income-tested benefits like old age security, which can be a major advantage in retirement. Your TFSA is more than just a savings account. It's one of the best long-term planning tools available to you. But how you use it, how it fits into your retirement plan, and how it interacts with your other accounts, that all depends on having the right structure in place. If you're not sure your TFSA is being used to its full potential, or you'd like to explore how it fits into your overall retirement or tax strategy, I'd be happy to help. Click the link in the description to book a call with me or my team. We'll walk you through your situation, identify opportunities, and help you make the most of what's available to you. Thanks for watching, and I'll see you in the next one.